Hi, how are you? This morning we're here with Eric Papesh, who's the portfolio specialist focused on smaller companies at T. Rowe Price. And I think it's a opportune time to be talking about smaller companies. I was just saying to Eric that if you were to look back over the past 40 years, coming out of the prior 4 recessions that we've had in the US, smaller cap companies have dramatically outperformed. And I guess, just to start things off, I guess I wonder if that trend will happen again. Do we think that this is a great moment or an interesting moment for small cap companies in the US? So I'll jump right in and
thanks
start
for the question,
there.
Ralph. And okay, thank you for the question. I appreciate it. I mean, you're absolutely right. The historical track record would suggest that small cap companies in the US are likely to lead their larger cap peers coming out of the recession that we're currently in. And you mentioned the last, I think, 4 recessions. I've actually seen data that suggests that I think there's been maybe 11 recessions in kind of the post-World War II period. And I think in 10 out of the 11 periods, we've seen leadership from the smaller end of the market. So, I do think there's obviously a precedent that would suggest that small cap companies are likely to do a pretty good job going forward. We've seen signs of that recently. From the kind of the March lows, we've seen better performance from small cap versus large. The obvious fact probably is that they underperformed going into the downdraft that we saw in Q1, but kind of from March, mid-March or so, they're up by 15-20% in large cap. So early days, but I think there's more to come.
Now, are there a consistent set of conditions that have been in place during those recovery periods that have led to, in your opinion, the small cap outperformance? Is there sort of an economic backdrop? Is there certain, is it, treasury yields moving in a certain direction? Is it spreads? Is it growth? What do you attribute it to, or what do you see? And do you see those things this time around as well?
Yeah, I mean, I think that the underlying commonality in most, if not all of those environments, is just better GDP growth, better economic activity and growth within the US, right? Things getting better and improving. The reality is, these are more domestically oriented businesses, right? They don't have international investments or divisions in many cases, right? Compared to the large multinationals. So they tend to be more linked to the underlying US economy. So again, for better or worse, right? If the economy in the US is slowing, you tend to see that played out in weaker performance from small cap. But when things are improving, are getting better, you tend to get leadership from these stocks that are more like.
Right. When you take a deep dive into the index and sort of look at the sector breakdown there, one of the things that you see is that relative to the S&P 500, you have a smaller percentage of technology shares, maybe 13% or 14%, I think, in the small cap index, and probably 27% or so in the S&P 500. You have a larger exposure to financials. I guess the question is maybe there's be a transition to financials, or maybe you guys are selecting within the technology. What are you guys doing in sectors? What are you seeing, and what's your expectation there? There's a lot to that question, but
I'll take it one step at a time, right? I mean, we are finding a lot of opportunities in the current environment within the technology sector, right? So our U.S. smaller companies portfolio it's a small mid cap strategy. So the benchmark is the Russell 2500 index. So the way to think about kind of the investable universe is US companies that are smaller than about $15 billion or so in market cap. So the benchmark of the strategy has a technology weight of about 17 or 18% of the index is tech related. So it is a smaller portion than large cap, like the S&P, for example. And we are, and relative to a benchmark of about 17 or 18% technology, we are closer to 21%. So it's slightly overweight. We're finding a lot of exciting opportunities there. Historically, it's been a very fruitful area of the market for us. We've done very well in terms of our ability to identify, unique, differentiated technology investments, and from an attribution standpoint, it's been a pretty good area of the portfolio for us. We haven't been as constructive for a while on financials. Obviously, the low rate environment put a lot of pressure on kind of traditional spread-based business models. More recently, we've been a little bit more encouraged selectively in some of these regional banks with strong market positions, good demographics, right, around their key markets in the U.S. So our financials team has been a little bit more constructive on the likely path of kind of credit, right? Credit conditions may not, in fact, be as bad as feared, right? Charge-offs and kind of asset losses. So we have been a little bit more constructive recently, but we are still a little bit light relative to the bench in terms of our financial exposure currently.
That's a great answer. Just sort of hearing that you guys are beginning to sort of tiptoe into the financials. Are you looking at other cyclical sectors as well, sort of industrials and materials, those sorts of things? Or where are your other overweights?
Yeah, absolutely. So, it's been such a surprising year, right, in so many ways. Think about the downdraft we had in the first quarter, followed by the exceptional rebound in Q2, and again, markets got higher in the most recent quarter. We were finding more attractive opportunities in kind of traditional value-oriented parts of the market in March, April, early May timeframe, kind of closer to the trough of the market. From the March lows, we've seen a recovery of 60-ish% in small cap U.S. equities, which is just shocking to me when you think about the real underlying economic damage in the U.S. and globally. So we were adding selectively to some industrials that were under a tremendous amount of pressure in, again, kind of March, April, May timeframe. Financials were an area also that we were selectively increasing our exposure. Consumer, right? A lot of the consumer-facing businesses had to close doors for weeks, if not months, to try to combat the spread of the COVID crisis or virus. So selectively taking advantage of concerns on individual businesses that we felt were sufficiently able to navigate near-term challenges, and then looking forward, right, we're likely to emerge in probably stronger competitive positions, right, relative to peers on the other side of this. So again, industrials would be a good example of that. Consumer financials would kind of fit that bill as well. And again, I think those are more kind of value-oriented parts of the market. Historically, our portfolio has skewed a little bit towards the growth side of the market, right? We've always really tried to have broad exposure to the full range of the small and mid-caps equity market. So core, value, and growth that are all kind of bottom-up, fundamentally oriented investment ideas. And that balance has really allowed us to deliver a pretty consistent pattern of performance to our clients. But we have traditionally skewed a little bit towards the growth side. And again, given some of the unique aspects or dynamics around the recent downdraft, we were finding some more attractive opportunities on the value side of the market.
Interesting. Thank you very much. And just thinking about, valuation. Obviously, when we look at the S&P 500 or larger cap companies, this is a topic that comes up quite a bit. Valuation at this point, based on most metrics, it seems extended. And in some cases, at the highest levels, at the highest absolute levels, I would say, since the dot-com bubble. But then we look at treasury bond yields and we sort of say, well, on a relative basis, maybe these valuations make some sense, or at least are justifiable. Where are the valuations today on the small cap universe, sort of versus its history? And then, as you look at your portfolio, is it sort of similar to that, or is it, higher or lower? And how are you guys seeing valuation?
Yeah, that's a great question, and it's hard to make a real strong argument on the market today from a valuation perspective. So the U.S. equity market, as are most major segments of capital markets globally, I think fairly extended, right, from a valuation standpoint. It doesn't really matter what traditional kind of metric you want to use. Most parts of equity markets globally are richly priced. I think from a relative valuation standpoint, there is a strong argument today to lead you to have a allocation, right? So if you look over the long term, the relative valuation of small cap today is pretty compelling versus large cap U.S. equities. Kind of like I think it's like the 15th-ish percentile level. So from similar levels historically as where we are today, you've tended to see better performance over the subsequent 12, 18 months from small cap. So I do think they're less demanding, right, from a valuation perspective. But I think it's pretty difficult also just to use traditional valuation metrics currently, given the ongoing uncertainty that we're likely to continue to face, right? So price to forward earnings, well, that the range around the forward earnings numbers got to be pretty wide, right? So we're using a range of valuation metrics to try to determine what's a reasonable level that we should be willing to pay for different businesses. So some asset-based metrics, right? Some cash flow-based metrics, and you probably need to extend the time horizon in which you're really willing to think about these businesses too. I think there's a lot of optimism built into kind of traditional consensus earnings expectations for large cap as well as small cap currently, right? And I think our bet would be that things are probably going to take a little bit longer to kind of get back to maybe 2019 levels than the market's really expecting right now. So, historically we have tried to employ a longer term outlook, right? Just in the strategy generally being willing to think about what companies can look like over a 2, 3, 4, 5 year window of time, and not be overly focused on just say the 12-month forward number. And I think if you're willing to do that gives you some opportunities too, right? Kind of time horizon arbitrage. And I think it's probably even more important given the uncertainties in today's market in many respects.
I think that idea of extending the time horizon is really makes a lot of sense here. Like you said, I think there are so many unknowns. Obviously, starting next week, we've got the election in the U.S. Do you, are you guys positioned in any certain way going into the election? Are you sort of saying, listen, if Trump wins, it might be a little bit better for this sector, but we need to hedge it with a Biden win or vice versa, and maybe thinking about things like a Democratic sweep, stimulus, all of these issues that we talk about on a regular basis, and then I guess underlying all of those is the uncertainty surrounding COVID and the reemergence or the acceleration again of infections and hospitalizations. and sort of the timing difference that seems to be developing between that and the implementation of a second fiscal stimulus, or I guess yeah.
So politics, COVID, and stimulus, right?
Just easy questions.
Some pretty yeah, some pretty thorny questions. Tough. It's incredibly tough to have a confident view on issues like those, right? Yeah. So I'll take the political one first. I mean, we believe that our core competitive advantage is bottom-up security selection, right? So that's what we really want to focus on in putting a portfolio of equities together. We don't have any unique insights on kind of the political backdrop. We have very good analysts in Baltimore and in DC, which is where the firm is based, that help us try to frame the issues that are important for equity markets around the political backdrop. But that is absolutely not our competitive advantage. So we try to, and we spend a lot of time trying to make sure that we don't have a portfolio that can only do well should Biden win or should Trump win or kind of the Senate or the House go a certain way. So the reality is we've got a number of investments in the portfolio that would probably be better off under either scenario next week in the U.S. I mean, I think a lot can change depending on not just who wins the White House, but also which party gains control of the Senate, and then even beyond that, in the case of Biden winning next week, what are the who is he going to put in charge of key cabinet positions, right? I think will have a bearing on what the underlying policy will look like, next year and going forward. So it's difficult, right? Obviously, anything with kind of a renewables bent right to the story or the investment thesis would probably see better performance, or certainly a better backdrop should Biden win and should the Democrats take control of the Senate. Conversely, maybe restaurants, retailers, companies with higher wage pressures, right, could see some difficulties in the case of, again, kind of a blue wave, right, where wages would probably be expected to increase, crimping margins a little bit. If Trump was successful, then obviously the financials would probably see a bit of benefit. The material space, energy would probably see some support there too. So, it's tough. I think it will be a positive to have uncertainty, some degree of uncertainty removed from the market, right? Kind of irrespective of which way, the election goes next Tuesday. I think just having a little more clarity would probably be, a positive. The other one that's talked about a lot is just, the potential for higher taxes, right? Corporate taxes, individual taxes in the U.S. That would probably be somewhat of an overhang on the broader market as well. So we'll see. We'll make changes to the portfolio once we've got a little more clarity on which way things are likely to shape up as well.
Now, one of the things.
COVID.
Yes, perfect.
I think ultimately, our ability to combat the pandemic, is hugely impactful on where equity markets go over the next 12, 18, 24 months. And I think it's likely to be a case of kind of 2 steps forward, 1 step back, right? As we need to pause, different actions in response to rising infection rates, in different parts of the country or globally, right? For that matter, we have in our portfolio, we've got a number of names that have really performed well, kind of year to date, in part due to trends related to COVID. So kind of the work from home story putting a bid on select software names or technology names. Some healthcare investments we have in the portfolio have really, been caught up in some of the changes to the economy and the market related to COVID. On the flip side, again, obviously, we've had some exposure to consumer-facing names, to some industrials earlier in the year that have been under pressure, on the flip side. So, short answer would be, I think it's likely to be with us for a while, and until we get a vaccine that's successful and widely available, I think this is going to be, something we need to learn how to live with.
And again, like you said, I think that sort of extending one's time horizon in order to look through some of the noise that you just spoke about is critical here. You did touch on something when you were talking about Biden, and I think his policy is obviously a lot more focused on the climate, a lot more focused on environmental issues than the Trump policy has been. ESG, corporate responsibility, are topics that we're talking to our clients much more about. Is that something that you guys are thinking about when you're making investments for the fund, in addition to the sort of broader fundamentals? Is it, something that you've seen that maybe impacts performance or anything like that? But ESG is definitely a consideration that we're thinking more and more about here.
Absolutely, as are we. So, T. Rowe has made significant strides in our ESG capabilities over the last 13, 14 years or so. The effort was probably initially more focused on the governance, right, aspect of ESG. We've used different kind of third-party providers for information on ESG metrics of the companies in which we invest. I'd say, the last significant evolution was the hiring of a woman to head our kind of environmental and social area within the ESG effort, that has really kind of institutionalized our ability to evaluate the broad investment landscape through kind of a quantitative approach, to flag key issues for different businesses depending on which industries they operate within, and then working with the existing fundamental research analysts to do a deeper dive on those issues, given that that's where the deepest knowledge really resides within the organization from a company specific standpoint. So dedicated ESG experts working hand in hand with the more traditional kind of fundamental investment analysts, if you will, to understand key issues for different businesses that will either serve as a headwind or a tailwind to their long-term kind of growth potential, right? And I think the increasing attention that ESG issues has received over the last 5 or 10 years is only likely to accelerate going forward. So if you're not in a position, from my standpoint, if you're not in a position to really have a deep understanding of these issues and incorporate those issues into the outlook for the individual businesses, you're going to be at a disadvantage.
Right. I think that's right. Just talking about the fund itself specifically, how long has the team been together? Can you just talk about the team a little bit, and then we'll dig into that?
Yeah, absolutely. So ESG was launched in 2001, and again, it's benchmarked to the Russell 2500 index, which is not as widely used or as commonly probably as kind of the Russell 2000, right? Pure small cap index. So a little bit larger in cap and quite a bit more diversified in terms of just number of names in the portfolio or in the benchmark, right? So almost 20-year track record at this point. Kurt Organt is the portfolio manager on the strategy today, and he's been working with the strategy initially as an analyst since it was launched. He's been formally serving as the portfolio manager now for close to 2 years now. We've had a retirement actually a couple retirements over that 20-year period of time that has caused some changes to the lead portfolio manager role. But stability across the broader small and mid cap team has been really one of the hallmarks, I think, of the organization. We've got a number of portfolio managers that have been in the same role, managing their dedicated portfolios for 20 plus years now at this point. So a lot of institutional knowledge that's been built up within this team over the past couple decades.
And when you think about the performance of the fund, do you think of it as pretty highly correlated with the larger caps? Is it, should we think of it as, is it sort of a high beta version of large caps? Is it a little bit not correlated, so it might be a hedge? How do you see it? How has it been?
Yeah, I mean, actively investing in small and mid cap U.S. equities is just it's a wonderful part of the market to pick stocks from within, right? Just the inefficiencies as you go down cap, and the ability for a well-resourced organization to spend the time and money getting out into the field effectively and turning over a lot of rocks with hopes that one or two of them is actually a pretty compelling opportunity. So a tremendous amount of just idiosyncratic risk, right, or opportunities that is identified by a large team of fundamental research analysts at T. Rowe. We've got over 100 individual equity analysts that are covering U.S. industries for us, right? So they are assigned an industry. They're expected to know that industry up and down the cap spectrum. So they're covering the small cap companies as well as the mid and large cap players in the market. And they're covering the traditional kind of growth and value stories within that industry. So, they are responsible for identifying the most compelling risk-adjusted opportunities for us in the market. And again, just the opportunities to identify a uniquely positioned company that may be very small, maybe involved in a very small niche little industry, but they do, right? Again, they've got a competitive advantage, is just tremendously exciting.
It is. I think that people that aren't that familiar with small cap investing don't realize how sort of underserved that I guess cap portion of the market has been over the past 10 or 15 years. And so there are those, like you said, idiosyncratic opportunities with significant upside, just simply because not enough people are doing the work. They're not out there meeting with the companies, meeting with the management teams, identifying maybe competitive advantages, attractive valuations, catalysts, all of those different things. So there really is an interesting opportunity within that space. Also thinking of the fund, how big is it currently? Do you guys have a capacity limit? Do you like to keep it at a certain size because of the opportunity set? Or, how is that right now?
Yeah, so the strategy in total is about $1.6 billion today. And we don't have any hard and fast capacity limit that's been determined at this point. We think very closely as an organization about, what's a reasonable level of assets to manage within a given strategy. And we've got a very long history as an organization closing portfolios when we feel that's in the best interests of existing clients. So that's a decision that's made in large part by the portfolio manager, right, on the individual strategy. If he or she felt that his ability to implement his best thinking was being impaired, right, that would be largely within his rights, effectively, to make some changes or discuss some changes being made. But right now it is not an issue at all. And one of the benefits of having a larger footprint in the market is just the resources that you can devote, right, to uncovering some of these less well followed ideas in the market.
When, going back to the idea of extending the time horizon and sort of thinking about market or economic cycles, when we think about, over a 3-year period or a 5-year period or something like that, and you think about the Russell 2500 performance, what should somebody's expectation for the fund be? What's the goal? Is it to outperform the Russell 2500 by 200 basis points over a market cycle, or 3 years or 5 years or something like that? And if I'm breaching any compliance or going into gray areas for compliance reasons, let me know.
Yeah, so we don't have a formally established kind of excess return target. That's going to largely be dependent on any different market environment, right? To some extent. The historical track record would support levels that you just mentioned and then some. So we've been able to historically deliver clients with a very attractive return relative to other options that they've got, whether that's other actively managed small cap strategies or passive vehicles such as a benchmark. So and again, dependent on the market opportunity, the backdrop. The performance recently has been better than I think anybody should reasonably expect to see on a consistent basis going forward, right? So in the range of 10, 11, 12% better returns over the last 12 months than the index, right? And again, I just think that's probably a little bit much to expect on a consistent, repeatable basis. One of the hallmarks of the strategy. Go ahead.
Just because there's a little bit of a lag here, and I wanted to be sure I heard you properly. Your team has beaten the index, the Russell 2500, by 10 to 12% over the last 12 months.
That's about right. Yeah. And obviously depending on the share class and the fee expenses and everything else, but in that range. And again, right, I wouldn't want anybody to expect that on a consistent, repeatable basis over the next year or 2 or 3 years, right? So what we have always prided ourselves in on the strategy is delivering clients with a consistent pattern of excess returns, right? So stepping back, very broadly diversified portfolio, right? We own roughly 170 individual investments in the portfolio. We tend not to have any outsized kind of sector bets embedded in the portfolio. We tend not to have outsized kind of risk factor exposures in the portfolio, right? So we don't have a momentum-oriented strategy or deep value strategy, right? We don't have a 2x weight to technology, for example. It tends to look from a sector and kind of factor standpoint very similar to the underlying index. And if you go back to what I mentioned earlier, we believe our core competitive advantage as an organization is really just identifying mispriced equities, right? So that's what we want to drive success for our clients. So the portfolio is designed in a way that as long as the broader team is identifying those mispriced assets, we've got a chance of winning in very different market environments. Again, that emphasis of consistency. So if you look back over the last 10 years, in 9 out of the 10 years, we've outperformed the index in very different market environments, and that's net of fees, right?
Absolutely.
And again, I think looking at some extremes in the last 10 years, when the market's been down sharply, we've really protected capital meaningfully better than the index on the downside. When the market's been up sharply, again, we've tended to outperform as well, just because of the quality of the underlying research inputs has been very, very strong.
That's fantastic. Congratulations.
Well, it's been yeah, and I'd maybe just there's many different ways to invest, obviously, right? Many different ways to skin a cat. Our approach emphasizes consistency and repeatability. I'd say, right, there's other successful investors, obviously, in the small cap market that have more concentrated approaches, right? That will take bigger bets, whether it's from a factor standpoint or, you know, a sector standpoint. And when those things go your way, right, you can look like a hero. You know, my view is that a lot of those approaches introduce a little bit more volatility, right? Sometimes you're benefited by that, sometimes you're not, but it's a different approach. Ours is one more that emphasizes kind of consistency and durability and repeatability, you know, of the process.
That's fantastic. Thank you. Thank you for that. There are a couple of things that I wanted to reemphasize here, and then I'll ask you sort of a final question. You know, I think that the first thing I wanted to reemphasize is, you know, we started off this discussion talking about the current economic environment in the US coming out of a recession. You and I both made the point that historically, coming out of recessions, small and maybe small and mid-cap companies have outperformed the S&P 500. We're beginning to see a little bit of that. I think, you know, this period since March, what we've seen is small cap relative performance sort of bounce around in a range over the past couple of months, you know, and maybe heading towards some sort of sustainable period of outperformance if history were to repeat itself. So from a macro point of view, it sounds like, you know, we have the foundation or the foundation that in the past has benefited small cap companies. You know, you mentioned, we talked a little bit about valuation, and you said, listen, valuation across the world, across equity markets globally is expensive, but right now, small cap to large cap valuation is in the cheapest, I think you said 15% of the time. The relative valuation of small to large is attractive here. And then, you know, we discussed, you know, your ability to, or T. Rowe's ability to go out and find idiosyncratic opportunities that has clearly led to, you said, outperformance in 9 of the last 10 years versus the benchmark, significant outperformance in the last 12 months, which, you know, like you said, may or may not be repeatable, but you know, the emphasis being on consistent, repeatable returns and outperformance, which you guys have been able to achieve. And then I think the final thing that I wanted to highlight was we discussed, you know, the number of unknowns that we have right now in the macro environment, from the election to COVID to stimulus. And, you know, I think your view on sort of extending time horizon and also the fund's ability to navigate different, obviously very different market environments over the past 9 or 10 years and navigate successfully through those has been impressive. I guess my one final question is did I miss anything there? Is there something that people should know about? And also, I guess from a firm, I should mention the fact that you guys are focused on ESG and are taking that into account when you're making investments through the fund. But again, I come back to, did I miss anything? Is there something that I'm not thinking about that I should be? Anything? Any final thoughts that we should add here that people should consider when reviewing the fund?
That's a great summary. I appreciate the comments. I think that was spot on in terms of what I would hope investors would take away from the conversation. You know, I just for individuals that are maybe not quite as familiar with T. Rowe Price, I just highlight, you know, the fact that we do have a long history of successfully investing in the small and mid cap segment of the U.S. equity market. You know, that's obviously been positive for, you know, our investors, our clients that we've partnered with in the past. It's also benefited investors and clients that are investing in our large cap strategies at the firm, right? So the ability to to get to know an early stage company at an earlier point in its life cycle has been, I think, a huge benefit and advantage for T. Rowe's large, mid cap and large cap equity portfolio over time. So, being familiar with the business model and the management team and the strategy before something becomes a large cap name, I think has been, very, very important. So, some names that I think are maybe illustrative of what I'm talking about that we've owned in smaller companies in the past, again, at earlier points in their life cycle, names like Netflix or Tesla, Salesforce.com. Today, everyone knows who those businesses are, right? Who those companies are. But when we were owning them in smaller companies, they were under the radar effectively of a lot of other investors. And so, I think just the broader U.S. equity platform at T. Rowe really benefits by our small and mid cap expertise.
And we've sort of covered this, but not directly. So I do want to address it with you. Passive versus active. One of the things that we see is the competition with the ETFs. Obviously you guys have done a great job in the active universe, but I'm sure you address a similar question on a regular basis. Your thoughts on that?
Absolutely. Yeah. Yeah. And I break it down again into time frames a little bit, right? So short term, near term, I think passive makes life of a lot of active investors pretty difficult. Right. When money is flowing on kind of thematic grounds, right? Or people want to own stocks based on kind of what sector, they're classified in, rather than the underlying fundamentals, right? An active investor can be out of the market for a period of time. So short-term difficult. I think longer term, if you extend that horizon, that presents opportunities for traditional fundamental investors to build positions, to step into names that are being influenced by passive flows rather than underlying fundamentals. So with a longer term orientation, I think passive and active can coexist. And in fact, again, longer term orientation, I think passive actually does a skilled active manager a favor in that regard.
Whoops, I lost myself. Here we are. Well, great.
You're back.
I'm back. It's a miracle of technology. We need some smaller cap companies to work on my Wi-Fi. But hopefully, Eric, thank you so much. I mean, it was incredibly insightful. I hope everybody found it as interesting and as informative as I did. I really appreciate the time, the input, the insight, and congratulations again on everything that's happening at T. Rowe. The performance speaks for itself. Has been, as you guys would hope, consistent, impressive, and these are not easy equity markets to navigate, and so I'm always impressed finding great managers that are able to do that, both on a short-term basis and a long-term basis. And I think it's an incredibly interesting time right now, where we are in the economic cycle for small cap investing, and you guys are some of the best out there doing it. So congratulations and thank you again. Really appreciate it.
Thanks for your time, Rob. Appreciate the questions and enjoyed the conversation. Take care.
Thank you.